Strategic Hook Shanghai Silver just closed at $104. Western futures continue to trade near $90. A double-digit premium remains in place, and it has not collapsed under arbitrage pressure. At the same time, the gold-silver ratio has slipped beneath its 50-day moving average, signaling a measurable shift in relative strength towards silver. Two markets, two prices, one metal. If global markets are efficient, price gaps of this magnitude should compress quickly. If Western futures represent true price discovery, physical markets should not consistently clear higher. And if supply is comfortably available, premiums should narrow as inventory responds. Yet the opposite is occurring. In the West, silver trades through leverage, margin, and rolling contracts. In Shanghai, silver trades closer to physical settlement dynamics. Western spreads appear orderly. Eastern premiums suggest tightening conditions. On the surface, volatility is contained. Beneath it, signals are shifting. This raises a structural question rather than a speculative one. Is this divergence merely temporary arbitrage friction tied to capital controls and logistics, or does it represent early-stage repricing within the market's plumbing? When regional premiums persist, ratios compress, and technical levels break simultaneously, disciplined observers pause. Because dislocations do not always begin loudly. They often begin quietly, inside the structure. Immediate context and event breakdown. Here's what the data confirms. Shanghai Futures Exchange Silver closed near the equivalent of $104. At the same time, COMEX Silver Futures in the West traded around $90. The spread between the two markets widened beyond $10 and held into the close. This is not an intraday anomaly. The premium has persisted rather than compressing under arbitrage pressure. Simultaneously, the gold-silver ratio slipped beneath its 50-day moving average. That technical break matters because the ratio measures relative capital allocation between gold and silver. When it compresses, it signals incremental preference shifting towards silver. This occurred alongside silver breaking above a prior resistance band in Western futures, confirming a technical expansion from consolidation into strength. Each of these developments independently may appear manageable. Together, they form a coherent structural snapshot. A persistent regional premium suggests localized demand concentration or constrained supply flow. A falling GSR implies capital rotating into higher beta within the precious metals complex. A breakout above resistance reflects technical confirmation rather than speculative noise. The timing increases relevance. These dynamics are unfolding during an active roll and settlement window when futures positioning transitions and delivery decisions approach. Price divergence during this period elevates sensitivity because leverage meets physical accountability. This is not about chasing momentum, it is about measuring dislocation. When two major exchanges price the same globally traded metal at materially different levels, basic scarcity math applies. Either supply flows adjust and compress the difference, or price must realign through repricing. Under normal conditions, arbitrage capital closes such gaps rapidly. The fact that this one persists implies friction somewhere in the system, whether regulatory, logistical, currency-based, or structural. And when friction prevents immediate convergence, disciplined analysts begin asking a deeper question. What mechanism is absorbing that imbalance, and how long can it continue to do so? Data stack and market plumbing. To judge whether this divergence is noise or signal, we have to leave the chart and look at the plumbing that clears silver: open interest, deliverable inventory, spreads, vault flows, and volatility. This is where headlines get filtered into mechanics. Start with open interest. Open interest is the number of outstanding futures contracts that have not been closed or offset. In silver, each contract represents a defined quantity of ounces. Open interest is not demand for metal, but it maps paper exposure. It tells you how much leverage must either roll forward, cash settle, or stand for delivery as contracts approach first notice. Now compare that exposure to registered inventory. On COMEX, vault reports separate eligible from registered. Eligible is metal that meets exchange specifications and sits in approved vaults, but it is not currently designated to satisfy delivery. Registered is metal that has been specifically warranted and made available for delivery against futures. That distinction matters because delivery draws from registered. Eligible can be converted to registered, but only if the owner chooses to warrant it, and that choice depends on incentives and perceived risk. Here is the scarcity math that matters. When paper exposure into a delivery window materially exceeds registered inventory, it does not mean a default is imminent. Most contracts do not go to delivery, but it defines leverage. It shows how dependent the system is on rolling behavior and voluntary conversion of metal from eligible to registered. The tighter that buffer becomes, the more sensitive pricing can be to changes in behavior. Delivery mechanics are straightforward but often misunderstood. First notice day is when longs who remain open can be assigned delivery notices. In the days leading into it, traders who do not want delivery typically roll. They sell the expiring month and buy a later month. That roll is normal. What matters is the percentage that does not roll. The number of contracts standing for delivery is the true pressure point, and historically, it is usually a minority of open interest. When that standing number rises relative to registered availability, the market responds through higher spreads, higher lease rates, or increased incentives for metal to be warranted. That is why vault flows matter more than social media narratives. Daily reports show ounces moving in and out, and they show category changes between eligible and registered. Persistent net withdrawals reduce the overall pool. A declining registered figure reduces immediate deliverability. Large conversions from eligible to registered can signal that incentives have shifted enough to coax metal onto the delivery line. The absence of new registrations is informative because it suggests holders require better terms. Next, watch the futures curve. In contango, later months trade above the front month, reflecting financing, storage, and time value. In backwardation, the front trades above the back, signaling immediate tightness. The market is willing to pay more for near-term metal than for future delivery. You do not need a dramatic headline for stress to appear. You need spreads to compress and then invert. The March-May or May-July spread is a real-time gauge of whether the market is paying up for prompt ounces. Volatility is the amplifier. Implied volatility rising into settlement tells you options markets are pricing larger potential moves. Open interest clustering near key strikes creates gamma dynamics. Dealers who are short options may need to buy as price rises or sell as price falls, mechanically reinforcing movement. Near settlement, small dislocations can become outsized because positioning is dense and time is short. Finally, if exchanges enforce limits or suspend accounts for rule violations, treat it as a mechanical risk signal, not a conspiracy. It usually means concentration or turnover exceeded permitted thresholds. Watch how open interest migrates after first notice and track issued delivery notices daily. That sequence shows whether pressure is real or just positioning on the tape. The point is not drama. The point is that when multiple plumbing indicators shift together, inventory behavior, spread behavior, volatility behavior, the market is telling you where stress would show up first. And that sets the stage for the structural explanation of why East and West can print two prices for the same metal. Structural explanation layer. Price disconnects do not emerge randomly. They form when two market structures operate under different constraints. Western silver trading is heavily derivative-based. COMEX functions primarily as a leveraged pricing venue, where the majority of contracts are rolled, offset, or hedged rather than settled physically. Liquidity is deep, capital is mobile, and financing flows shape the curve. The dominant activity is balance sheet positioning, not metal transfer. Shanghai operates differently. While it also lists futures, its ecosystem is more closely tied to industrial demand, local fabrication, and state-influenced capital controls. Physical settlement culture is stronger, and cross-border arbitrage is not frictionless. That distinction matters. When price divergence appears, Western participants can quickly short or hedge paper exposure. Eastern participants are more constrained by domestic funding rules, currency conversion processes, and physical sourcing. Capital controls limit instantaneous arbitrage. You cannot always buy metal in one jurisdiction, move capital seamlessly, and sell into another without regulatory, tax, or quota constraints. Foreign exchange mechanics introduce additional distortion. If currency volatility or conversion costs rise, apparent price gaps may persist even when theoretical arbitrage exists. Tax structures, import duties, or export licensing requirements can widen premiums further. What appears inefficient may in fact reflect embedded friction. History shows how these structural differences surface under stress. In 2008, delivery demand surged during financial panic, compressing spreads and forcing participants to prioritize access to physical supply. In 2020, silver experienced temporary backwardation as supply chain disruption met leveraged positioning, triggering rapid repricing. In 2022, the London Metal Exchange nickel dislocation demonstrated how concentrated derivatives exposure can overwhelm orderly price discovery when physical supply meets leveraged shorts. None of these events were predicted precisely, but each followed a recognizable progression. Stress typically unfolds in stages. First, spreads tighten. The cost of immediate metal rises relative to future delivery. Second, backwardation emerges, signaling urgency. Third, vault withdrawals accelerate as participants secure physical inventory. Fourth, volatility expands as options markets reprice risk. Finally, forced position reduction occurs as leverage becomes unsustainable under widening price swings. It is important to understand that disconnects can persist far longer than anticipated. Structural friction can absorb pressure for weeks or months. But when convergence arrives, it rarely happens gradually. Markets tend to resolve imbalance through decisive realignment. The key is not predicting timing, but recognizing the sequence of signals that precede it. And that sequence becomes more relevant as the calendar approaches the next pressure window. Countdown, chop, pressure window. As the calendar approaches first notice day, timing begins to matter more than commentary. Settlement cycles are not emotional events. They are mechanical checkpoints. Contracts must either be rolled forward, cash settled, or stand for delivery. During this window, leverage stops being theoretical and becomes operational. The roll window typically absorbs the majority of open interest. Traders who do not want physical settlement close exposure in the expiring month and reopen in a deferred contract. That process is routine. What is not routine is when a higher than normal percentage chooses to stand. That is when paper exposure collides with registered inventory and pricing sensitivity increases. This is why proximity matters. Into settlement, decisions must be made. Shorts must determine whether to source metal or offset risk. Longs must decide whether to take delivery or monetize premium. The closer the clock moves, the less flexibility remains. It is not about panic, it is about structure narrowing options. 48 hours does not imply explosion. It implies clarity. The system reveals its internal balance when contracts stop rolling and start settling. If everything functions smoothly, spreads stabilize, and inventory behavior normalizes. If pressure builds, it appears first in measurable data. A disciplined observer adopts a checklist approach rather than a narrative one. Monitor the percentage of contracts standing into first notice relative to historical norms. Track daily registered inventory changes and eligible to registered conversions. Watch nearby spreads for compression or inversion. Observe whether the Shanghai premium narrows under arbitrage or widens further. Settlement cycles compress time. They force resolution. And when regional price divergence overlaps with this window, even small structural imbalances become visible, setting the stage for how macro forces may amplify or dampen what the plumbing reveals next. Macro overlay. Step back from the exchange mechanics and widen the lens. The dollar index sets the global liquidity backdrop. When the dollar strengthens persistently, commodities face headwinds. When it softens, pricing pressure often lifts across metals. Federal Reserve policy shapes that trajectory through rate guidance and balance sheet management. But what matters most for silver is not nominal rates, it is real yields. When inflation expectations rise faster than yields, real rates compress. Historically, precious metals respond positively to that compression because the opportunity cost of holding non-yielding assets declines. Oil adds another dimension. Elevated energy prices increase industrial input costs and signal broader inflationary pressure. Silver sits inside photovoltaic demand, electronics, and industrial fabrication. When growth stabilizes or accelerates, physical consumption rises alongside monetary demand. Geopolitical stress further complicates this mix. Supply chain vulnerability, sanctions, or trade friction can tighten commodity flows even without outright shortages. Central bank accumulation has focused primarily on gold, yet the broader hard asset rotation influences silver indirectly. When sovereign institutions diversify reserves away from dollar-denominated assets, trust in fiat structures becomes a topic of policy discussion. Inflation persistence reinforces that dynamic. Silver participates in that conversation because it trades at the intersection of monetary hedge and industrial necessity. This macro backdrop interacts with the gold-silver ratio. When the ratio compresses, capital shifts toward the higher beta metal. Silver typically outperforms gold during phases of improving economic confidence within hard assets. It signals risk appetite not for equities, but within the monetary metals complex itself. Silver therefore occupies a unique position. It is simultaneously a monetary metal, an industrial input, and an increasingly strategic material. Macro forces alone do not create structural dislocation. But when supportive macro conditions align with tightening plumbing signals, they can reinforce and accelerate whatever imbalance the settlement cycle begins to expose. Bull case. The upside thesis does not rely on emotion, it relies on sequence. If the Shanghai premium persists rather than compressing, it signals sustained localized demand or constrained supply flow. Should that premium continue widening during settlement cycles, arbitrage strain increases. Capital will attempt to close the gap, but structural friction may delay convergence. At the same time, continued compression in the gold-silver ratio would confirm relative capital rotation into silver. Historically, sustained GSR declines coincide with phases of stronger silver momentum within the metals complex. If nearby spreads begin tightening toward inversion, that would indicate growing preference for prompt metal over deferred delivery. Add ETF inflows to the equation. When exchange-traded vehicles experience net accumulation, custodians must source physical silver, reducing floating supply. If vault reports begin showing consistent net withdrawals or declining registered inventory without offsetting replenishment, leverage sensitivity increases. Overlay macro reinforcement, real yield compression, softer dollar conditions, and stable or rising industrial demand. None of these alone create dislocation. Together, they can amplify structural tightening. The mechanism unfolds gradually. Premium persists. Arbitrage capital presses against constraints. Spreads tighten toward backwardation. Delivery interest rises. Volatility expands as positioning adjusts. There are no price targets embedded in this thesis. There is only a pathway defined by observable data. If multiple components align simultaneously, the probability of accelerated repricing increases, not because it must, but because the structure would leave fewer outlets for imbalance to hide. Bear case discipline requires acknowledging that structural tension does not guarantee structural rupture. The most probable outcome in many future cycles is normalization rather than escalation. A persistent premium can narrow quickly if arbitrage pathways open or if regional demand moderates. Capital controls can ease. Import flows can adjust. What appears rigid can soften. If the roll window completes smoothly and the percentage of contracts standing for delivery remains within historical norms, pressure dissipates. Registered inventory can replenish through eligible conversions if incentives shift. Vault reports have shown in prior cycles that metal flows respond when spreads justify it. A strengthening dollar would also weigh on silver pricing. Higher real yields reduce monetary metal appeal. If industrial indicators weaken, fabrication demand could soften, reducing urgency in physical markets. ETF outflows would return metal to custodial supply, increasing available inventory and easing tightness narratives. Spreads, which often telegraph stress first, can normalize without fanfare. Backwardation signals urgency, but contango is the structural baseline in commodities. Delivery ratios historically remain a small fraction of open interest. Most contracts settle without incident. Premiums collapse faster than they expand. Volatility can contract as quickly as it spikes. The majority of settlement cycles pass without systemic disruption. This perspective does not negate the bull case, it preserves credibility. Markets routinely absorb imbalance. Recognizing that reality is what separates structural analysis from speculation. Data recap compression. Shanghai silver closed near $104, while Western futures trade around $90. Maintaining a persistent 10-plus premium. The gold-silver ratio has slipped below its 50-day moving average, signaling relative strength rotation towards silver. A settlement window is approaching, bringing delivery mechanics into focus. Open interest remains materially larger than registered inventory, defining leverage sensitivity within the system. Nearby spread behavior now becomes critical. Tightening or inversion would indicate preference for prompt metal. Vault flows and conversion activity will confirm whether supply adjusts or tightens. The structure is measurable. The next signals will come from data, not commentary alone. Disciplined close. This is education, not investment advice. Markets reward logic, not emotion. Watch the plumbing, not the headlines. Monitor spreads, inventory, and settlement behavior. Control position sizing. Observe structure with discipline. Let verified data confirm or invalidate the narrative before acting.